Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for years now. He's written the paid newsletter, The Bear Traps Report. He's also a former Lehman Brothers trader and vice president, and he wrote a best-selling book about his experiences there and Lehman Brothers failing. His newest book is How to Listen When Markets Speak. It's one of the top finance books available right now. Risks, Myths, and Investment Opportunities in a Radically Reshaped Economy. Larry McDonald, thank you for joining me.
Hi, Jason. Thank you very much for having me.
So, Larry, we're recording this interview on Tuesday, July 23rd, 2024. The 10-year U.S. Treasury yield, it's down. The yield is down. It's been a roller coaster the last 12 months. It's back down to 4.239. The dollar index is still above 104. I want to get your thoughts on the other central banks starting to cut rates. Do you think that this is going to add in a lot of liquidity into U.S. capital markets and asset prices?
Well, yeah, the key is that when there's divergence between the Fed and the rest of the world, that's not good because that tightens things up and strengthens the dollar, and the dollar tends to be a global wrecking ball. But as you can see, the data I run a Bloomberg chat behind me with different institutional investors in 20 plus countries, and the conversation is like, how many banks globally, Bank of Canada, Bank of England, how many banks are actually ahead of the Fed already easing? Dozens and dozens of banks. So as soon as the Fed, kind of starts moving with the rest of the world, that's where you get a weaker dollar and you get some support for commodities and some types of, different types of asset classes.
Do you think that a lot of that liquidity that those central banks, when they start to cut rates and they let inflation run hot, or they announce a new liquidity program to bail out their own domestic banks, do you think that a lot of that liquidity ends up in U.S. capital markets?
Yeah, so that's what's been happening. I mean, there's lots of liquidity now, even though they're basically like stealth, taking down they're offering liquidity even though they've been in a tightening cycle for the last year, ever since the banks blew up, right? Last March. And so they've been slowly but surely offering more and more liquidity. That's why financial conditions really screamed. If you look at the Chicago Fed Financial Conditions Index, it's like the easiest in years. Every single time they've opened the door an inch toward a softer path, even though they're not as soft as the rest of the world, but every time they've opened the door an inch to a softer path, we've seen a big explosion in liquidity, explosion in asset prices, and kind of a growing kind of financial conditions juicing up the wealth effect.
So you're in the Stanley Druckenmiller central bank liquidity flows camp, where he tracks net liquidity flows or liquidity flows being removed, and then which asset markets they end up in. You think that Stanley's correct on this?
I do, yeah. It's a very, I mean, especially with Bitcoin. I mean, these Bitcoin people, I mean, the evangelists, they're very deceptive, because at the end of the day, when you long Bitcoin, you're actually long liquidity. You're getting long liquidity. You're actually short equity volatility. Every time the VIX has been above 30, 35, 40, Bitcoin's been in a meaningful drawdown, more than 20%. In some cases, 50 or 60 or 80%. So yeah, there's certain asset classes that benefit from that excess liquidity. Bitcoin's one of them. Kind of the speculative stocks in certain areas are benefit as well.
That's actually perfect that you brought up volatility and liquidity, because I was actually going to ask you, and Stanley Druckenmiller has started to do this with some of his public filings with his stock positions, is he's been taking profits on stocks like NVIDIA, where he was ahead of the curve and accumulating shares, in 2021 and 2022. Now he's taking profits on those, and he's asset rotation. Do you think that there's a large scale asset rotation underway from money management out of some of these big tech and artificial intelligence stocks, and looking for undervalued and cheap, maybe oil and natural gas, uranium, other commodity stocks?
Yes, we saw this in 2021, and we're about to see it again. The biggest thing, so we run a Bloomberg, like I said, the Bloomberg chat behind me with institutional investors in 20 plus countries. And we had a conversation yesterday with a guy in the Valley, Silicon Valley. He's very close with a lot of the different CFOs of the Mag 7. He's been in the Valley 30 years. He knows the game around Capex now. And his point was that the Capex, the capital expenditures that have been driving up NVIDIA's stock price, it's been so insane. Like these guys, they're spending the capex. They've gone from 30 billion a year to about 170 billion a year, and that capex budget, that explosion over the last 2 years in capex, has increased the value of Nvidia because people take those numbers and they extrapolate them forward. And his point is it's like the Manhattan Project. These companies, the Facebooks of the world, they don't have a return on capital plan. And this is what I'm hearing from the people that are the closest to Silicon Valley. They are investing billions and billions and billions of dollars with no plan for return on capital. They don't understand how they're going to get the return on capital. But it's like the Manhattan Project. It's like it's kind of like what he compared to is the arms race, where it was Reagan versus Gorbachev, 1980. They're just spending money in capital expenditures, investments in artificial intelligence, but there's no real clear way they're going to get a return on capital. And if you're not spending the money, then you're going to get fired. It's just like it's very similar to the shale boom when the oil and gas companies they all got into this very addictive capex. Let's go find more and more shale, and it was this explosion with the technology. And in the end, it was a very nasty reversal. And I think that, and this is the most important part, the price action over the last, say, couple of weeks points toward a meaningful reversion, because it's not the news, it's how the market reacts to the news.
Okay, so by mean reversion, you mean that these capex projections, and Goldman Sachs just put out a report in the last couple of weeks. They're projecting $1 trillion in capex investment by over the next decade by mid 2030s, right? $1 trillion by the big tech companies. And they have to invest in this infrastructure. So this is not the typical big tech spending where they do software as a service, where Microsoft upgrades Microsoft Office with the new version that's low capex software as a service. They have to invest in new nuclear power plants. They have to invest in infrastructure, materials. They have to make sure they have cheap electricity. So there's a ton of extra capital expenditures for these next generation data centers before they start doing the tech component and the software component.
Exactly. So you've got companies that for 10 years have been companies that had tons of stock, tons of capital to buy back stock, right? They were cash cows, right? And now they're becoming capital intensive businesses. And all that means is the amount of capital that you have to put into this Manhattan Project is so daunting that it's going to start hitting the profits like about a year and a half from now. But the market knows that. And so, like you said, there's also a white paper that came up from Sequoia recently. And that Sequoia white paper said very similar thing to the Goldman report. And that's like, there's a lot of reckless capex without a plan to get return on investment. And what that does is that starts to hit, because these companies are so much more capital intensive now versus, say, 2 years ago, that really starts to hammer earnings like sometime in the next 12 to 18 months.
And here in Northern Virginia, I don't know if you know, Larry, I'm right outside of Washington, D.C. I've lived in the D.C. metro area for almost 25 years now. I mean, Amazon, Google, Microsoft, they're buying up land like crazy. Amazon, it seems like every couple of weeks is spending another $100 to $200 million buying up more land because they're planning on building what these university-sized next-generation data centers. I don't think there's enough cheap electricity and power for all these next-generation data centers that big tech has planned in this area.
100%. And that's what When Markets Speak is all about. So what our book does is it looks at Bitcoin. It looks at, Jason, there's 1 billion people in India that don't have air conditioning. There's 1 billion people in India that don't have air conditioning. So we've taken 5 million jobs out of the United States. We've raised the standard of living globally. GDP in India is exploding. If you're 20, 25, 30 years old in India, you're making 10 to 20 times more than your great grandparents. So we're creating energy consumers at a very high level, and we don't have the grid to support AI in the United States. We don't have the infrastructure to support we don't have the capex and oil and gas and metals to support this either, to support copper. Yeah, so there's really a massive disconnect between investments in the raw energy and infrastructure globally and actually the demand that's going to come from India. It's going to come from artificial intelligence. it's going to come from Bitcoin mining.
And to add to your points there about India, I think coal demand hit an all-time high for India in 2023. Their electricity demand is going parabolic. So despite what the Paris Accords, China and India are exempt from that. So they're investing in traditional nuclear power and traditional fossil fuels for electricity generation. And that's how they're going to fuel their economy and manufacturing.
Right. And like I said, there's a billion people that don't have air conditioning. And you're talking about a country with a very high temperature, average temperature. There's a billion people in China that don't have an automobile, roughly. And so, everybody's focused on this carbon neutral 2050. We make the point in the book, it's really carbon neutral globally in 2100.
So do you think then that this means that there's going to be have to be higher price floors for a lot of commodities, say for copper, that we're done with $2.50 a pound copper, that we're going to have $3.50, $4 a pound price floors for copper going forward, maybe even higher than that, in order to bring on new supply over the next 5, 10, 15 years?
Yes, and if you look at the new copper plants on planet Earth, we've got like one in the last 8, 10 years. And look at the most productive copper facility or copper complexes in the world. The mine in Panama, the first quantum mine, that mine was one of the most productive, pound for pound, per dollar investment. You can take the copper, get it out into the ocean very, very fast. And think about if you're producing copper in Africa, in the middle of Africa, you're just talking about getting that copper out to export is very difficult. And this mine in Panama was shut down politically. You look at Peru and Chile, copper mining because of political constraints, the copper production's, being very stressed. And so, yeah, copper, I think right now, you look at Freeport's down 20% off the highs. We think a lot of these copper names are coming back into the buy zone here because we went up, a lot on the AI infrastructure kind of expectations. We went up on euphoria, and then we're kind of coming down on impatience now. And that's going to open up a nice trade in the copper space.
I agree. I see absolutely huge supply side problems for copper, especially all the main producers of copper, like you mentioned, whether it's Chile, Peru, Mexico, a lot of these Latin American countries in recent elections, or whether it's a politician or a bureaucrat, it seems that they're starting to be anti-open pit mining. So some of these potential mines that would bring on a lot of copper supply or gold supply or silver supply, they're not even getting permits now, or they're talking about shutting them down, like you said, in Panama. I think Cobre Panama, that massive copper and gold mine, isn't it? It's over 1% of annual copper supply.
Right. It's like, I mean, it's just, it's so productive in terms of like new supply to the market. And now, I think the Panamanian government's going to reopen the mine, and what they'll do is they'll reopen it to close it. So that supply will come back. But we've still taken, like, it's been shut since the last November. And so, we've taken a lot of supply right off the market right there.
Wait, by opening it to close it, do you mean that they're going to open it under like additional environmental conditions, or are they just going to, because I mean, if they don't reopen the mine, what they're looking at lawsuits from the copper miner from Franco-Nevada, the royalty company. They're looking at loss of tax revenues. There's a bunch of people that are out of jobs. It's just very negative there. The only small group that's winning is the environmentalists and the NGOs that probably lobbied to get the mine shut down.
Yes. And so, I think in the international arbitration, the liability is enormous. And so the new government is a market-friendly government, much more so than the previous one. The new government just came in like 4 or 5 weeks ago. And so they're gonna make a shift. And what they'll do is, for political cover, they'll say we're gonna close it, but we're gonna close it over 25 or 30 or 40 years, and we're gonna reopen it to fund the closing. So it could literally be, I've heard some estimates of a 40 to 50 year closing, but that's reopening it. And so that's good. That'll support that. You'll see a bounce back in that mine for sure.
Oh, it sounds like political spin.
Yeah, that's exactly what it is. Yeah, exactly. We're going to close it, but over, decades and decades.
I actually found your work years ago because you were a uranium bull when everyone else hated it. I remember you were telling people that like the uranium Cameco uranium prices, it's cheap, it's hated, and the trolls for years. It was one of the best contrarian trades over the last couple of years. Do you think that uranium and the nuclear power bull market, is it a long-term bull market for you?
Yes, it's still in a very much a bull market, but the problem is there's a lot of hot money in that space, and it's not a very big space. So in other words, all the companies combined in the energy in the uranium space at like 42 billion dollars, maybe 45, something like that. So I mean, think of like that. Think of how small that is. So Nvidia is like $3,000 billion, right? $3,000 billion company. And the entire energy sector is a $45 billion company. The insanity of that is just the stupidity of that. It's just off the charts because you're going to need, uranium because of AI, uranium prices probably triple over the next 5 years, but there's so much hot money that comes into it. And when you kind of have like hot money, the money kind of comes in on euphoria, comes down on impatience, and the real money is will come in. It's just you have a lot of hot money moving in and out, so you get which creates these great opportunities where you have these big moves up and big. It's a high what we call a high beta sector, which means it moves dramatically more than the market.
Yeah, Cameco and these copper miners have had a sizable correction lately, so as other uranium plays. But long term, there needs to be investment made into these before we get to the next generation data centers. We have to have the reliable, cheap baseload electricity. The Washington Post ran an article in February citing experts about the data centers that are planned here in Northern Virginia, right outside of Washington, D.C. And the expert said we need 2 new nuclear power plants here to deal with all the electricity demand growth.
Yeah, exactly. And so we need nuclear power plants are going to come back online in Europe. They're going to come back online in Japan, um, California. I mean, there's just the story goes on and on and on. And then there's small modular plants that are going to, at the end of the day, the Amazons of the world, they probably will have a local power source that they control relative to, having to deal with a utility that could really shut them down. Because what's going to happen is these data centers are going to lean on the utility too much, and then the politics of like that is going to be so nasty. Where imagine like a utility where the data center is like juicing up the cost of electricity for 2 or 3 counties, and it's just going to create a political. So there's going to be a lot of pressure to create their own power supply, and then there's the grid itself. So the power grid is what we talk about in our book, When Markets Speak, is the power grid is 40 years old, in some spots 30 years old, and others 50 years old. And so when all that copper, all that aluminum, if you look at Alcoa now, Alcoa is very cheap relative to this like green transition over the next, 5, 10, 20 years. And that stock's actually pulled back as well because that Alcoa is going to be a solution in that AI slash copper. If copper gets too expensive, then aluminum comes back into play. So yeah, so I love Alcoa here as well.
They still use aluminum on a lot of those larger power lines over long distances. I mean, I don't know if long term if that's going to be the case if they're going to still do that, but as of now, they still use a lot of aluminum and steel.
Yes.
Do you, in terms of commodity risk reward, your favorite commodities for a bull market, would you say that uranium and nuclear power are one of your favorites, or do you have others that you like better?
Well, the way it works, as recession risk rises, the copper gold ratio starts to really expand. And if you look at the copper gold ratio, it just made a big break, in favor of gold versus copper. So at this stage, copper gets cheaper and cheaper because of that increasing recession risk. The Fed's telling you they're going to cut because of recession probabilities rising. And so that's scaring money out of the copper. So what you want to start doing as you move in toward recession, you want to start lightening your gold and start buying some more copper. One way to play that right now is Barrick, because Barrick Gold is now Barrick Copper and Gold. They've dramatically increased their copper production. The other thing is that platinum and palladium are the cheapest to gold in probably 40 or 50 years. And if you think of like the timeline of electric vehicles versus say hybrids, if you read the data, like research reports 5, 10 years ago, we were supposed to be here on electric vehicles. And what's happened is we're actually here and hybrids are here. In other words, the hybrids, which have catalytic converters, those hybrids, and Toyota's a big seller of hybrids. Those cars are very supportive of what we call, platinum and palladium, and the cheapness of platinum and palladium relative to gold is like one of the broadest, the highest extremes ever. So I think you want to be selling your gold and buying some of these, platinum ETFs. So you have like, but I keep it simple. Say you have $1 million in gold. You sell 200,000 and you diversify into silver and you diversify into platinum and palladium.
Yeah, I agree. Platinum and palladium are very cheap. I think they're below the cost of production. On the supply side, there's only 3 countries that produce the majority of the world's platinum and palladium. So you have Russia. And so like the European governments, the London Metals Exchange, the US does not want to buy metals from Russia. So I think the London Metals Exchange just put restrictions or an outright ban on Russian platinum and palladium and aluminum, other metals. And then the other countries are South Africa and Zimbabwe, which are not reliable. I think the South African platinum and palladium miners, they're running at enormous losses with higher input costs, labor, and electricity. So potentially there could be bankruptcies there.
Yeah, that's the risk. It's South Africa, we got labor and cost of production. But the stocks have been decimated, like Sibanye and Impala. I mean, they've really been decimated. But that's a very speculative way to play it. I had lunch with a big hedge fund client last week, and he's like, he's kind of not given up on commodity stocks in this space, but he's like, I'd rather just own the commodity. And so in the copper and the platinum space.
Yeah, Sprott just launched a physical copper trust. So it's only a month old. So we'll see how well it does. But the uranium trust that Sprott launched has been very, very popular.
Have you tracked the volume? Is there any volume on that copper fund?
It's so new. It's too new to really know anything. I think it's a good idea, and I think it has a good chance of success. So I'm cautiously optimistic. It's just too new to tell right now.
Okay.
It's literally a month old. So I was like, oh, that's a good idea, because this is something I've been discussing on other interviews. And I'm sure you can comment on this as well, since you cover a lot of commodity companies. But if you go back and look at the commodity price versus the producers the last 10 or 15 years, I mean, a lot of the producers, whether it's copper miners, gold miners, uranium miners, they've drastically underperformed the commodity price rising.
Right, exactly. And that's what happens in the early stages of any commodity bull market. People move into gold first, then the gold miners, then silver. And same thing with copper. In the beginning stage, people just want to own the commodity. But as the stock price, as the commodity goes up in value, then more and more speculative money comes in to the companies themselves.
Yeah, I agree. And also the commodities producers have been dealing with real inflation rates, not the consumer price index, much higher. And then they have like the other problems in emerging markets with like the miners, workers, and the unions. They want higher wages. You have falling ore grades. So that just hurts profit margins. And so the miners have not been producing the free cash flow at the relative gold price, a lot of these gold miners are not producing the free cash flow that a lot of people expected over the last couple of years. Although I'm cautiously optimistic that will change going forward.
Right.
So do you think then that gold is in a bull market, or you think that gold's due for a pullback? Because when I look at like the other central bank policies, I see a lot of demand for gold for retail investors in Asia, and non-G7 central banks seem to be dollar cost averaging gold versus US treasuries. Or do you think that gold's due for a correction then because a lot of people are too bullish?
I love the bull case. I just get nervous when the CFTC data on speculative positioning is this extreme. Typically, whenever we look at CFT, the Commodity Futures Trading Commission data, when it gets to like this, it's typically a bearish signal. But you can see what's happening is the Fed, we're doing about a 1.1 trillion a year of interest, and the fiscal deficit is 6-7% of GDP, which is World War I, World War II type neighborhood. And so if Kamala's elected or if Trump's elected, you get into this, kind of crazy MMT world where they just keep the deficits going, and eventually that forces the Fed to be more supportive of purchases of our debt, And that's what really gets you into this like, market where you can see gold go to 3,000. But that's why you just have to be careful along the way, because in any bull market, look at Nvidia a year ago, right? So the amount of speculative people that were coming into Nvidia was very overbought, and it had these drawdowns, but it's gone up. It went from essentially 18 months ago less than $1 trillion valuation to 3.3 trillion at one point. And so so you just have to be prepared for these drawdowns that will happen, and take advantage of them in this stage.
I think that's an important point you brought up with both political parties. It doesn't really matter who's in the White House in terms of DC spending. Same thing for Congress. I mean, the majority of people in power in Congress, they're not talking about spending cuts. There's no meaningful talks of actual spending cuts. It's in fact, it's the opposite from the majority of both political parties here in Congress about spending.
Yes, and the only wild card to that is if Trump is the president and the Democrats control the House and Senate. The probability of a real fiscal cliff gridlock in that scenario is high, because the vindictive, they won't be as supportive of spending. Like right now, the Republicans have been very supportive of spending with the Democrats. You're 100% right. But I just don't see the Democrats allowing Trump to do that. So we would have that fiscal cliff. But I think the smart money thinks that if Trump does win this time around, it's going to be with the House and Senate. It's probably not going to be close again. Now, I'm not saying he's going to win, but if he does win, it's most likely going to be a large win. Whereas if it's Kamala, then I think the probability of it being tighter, in other words, Kamala Harris and her running they most likely will not have control of the House and Senate.
Do you think the Fed's going to cut rates because of recession risk, or do you think the real reasons are going to be because DC can't afford interest payments on the national debt, and because a lot of these banks are starting to break with loan losses on consumer loans, auto loans, and commercial real estate?
Yeah, like Capital One tonight reported, larger provisions for credit losses. Higher interest rates are crushing the middle class consumer in election year. Dozens and we counted 80 plus companies, from Expedia to Starbucks to McDonald's. I mean, just Darden Restaurant, they're all talking about the consumer. That's, the bottom 60% of consumers, they're not a huge piece of overall consumption because the wealthy spend so much, but they are a large, they're a chunk. And so the bottom 60% of consumers are in a ton of pain. The political pressure on Powell is enormous to cut rates. And that's essentially what he's going to do. And he's going to cut before the inflation fight is really finished. It will be kind of an Arthur Burns moment, and that's going to really help commodities over the next 3 years.
Yeah, it looks like the lag effects are finally kicking into the real economy. We see this with the small business owner surveys, bankruptcies by small business, and then the middle class consumer, like you said, their savings seem to be gone and the credit card debt is spiking. But the people who don't have a lot of variable rate debt or revolving credit facilities, so the affluent who have benefited from higher stock prices and relatively high real estate prices, they're still doing well.
Exactly. If you have $10 million, a wealthy person, and $10 million in Palm Beach, your annual income went from $75,000 a year to close to $500,000 a year, thanks to the Fed. And that's a lot of money for excess consumption. That's why you see this incredible spread between American Express and, say, Capital One and some of the other financial companies, whether it be a lot of these finance companies like Synchrony, the buy now and pay later people. There's a huge spread between American Express, which represents the highly affluent consumer, and then the rest of these tertiary credit card companies that really represent subprime.
Yeah, I agree. And the businesses that cater to the lower income consumer or middle class, they're getting killed.
Yes, across the board, over and over again, Big Lots or Target. You can just go through retail spaces. Just the divergences in retail are something we've really never seen something like this. The Kohl's of the world, there's just the S&P is making new highs, and the market looks like it's really strong, but there are a lot of wounded companies out there, and And as the Fed starts to cut rates, then we're starting to see this flip. Like right now, there's $24 trillion in the NASDAQ 100, and there's only like $3 trillion in energy stocks. And in 2014, and it was like 4 trillion in the NASDAQ 100 versus say 3.4. So they were only 600 billion apart in 2014, 10 years ago. So it was 4 trillion versus 3.4, that's 600 billion apart. And now it's 24 trillion in the NASDAQ 100 versus 3. So now they're $21 trillion apart. And so the probability that we have a huge shift back toward companies that actually own hard assets is extremely high if in a sustained inflation world.
Do you think this type of sector rotation, if it does play out, is it going to be very volatile? Is it going to cause a big spike in the VIX? Could it potentially cause certain businesses to have immense problems with liquidity or funding like regional banks?
Well, there's a big debate around passive and, think about the top three stocks. 23% of the S&Ps in the top three stocks now. In 2019, that was like 8 or 9%. So the top three stocks are 23% of the S&P 500 composition. And in the 80s and 90s and 2010s, that number was anywhere between 7 to 9% with the top three companies. So, and when we talk about it in our book, the point I make in the book is at some point passive investing can be pretty evil. It's not what Jack Bogle really wanted. And so there's a lot of dumb money. There's a lot of complacency. You talk to people like David Einhorn. I sat down with he's president of Greenlight Capital, probably one of the smartest hedge fund managers that ever lived. And he's like, he goes on these conference calls with his team, and there's nobody on the calls. In other words, the active investor has been marginalized by this, gross, disgusting explosion into passive. Nobody's asking the hard questions, and it sets up for a very dangerous cocktail where at some point there's not going to be enough liquidity to get everybody out of, imagine a theater with a very small door in the end, and if there's any kind of fire now in the passive theater, the door's just not going to be big enough to get everybody to get the people out.
Yeah, I agree. And the index funds keep adding to the market cap weighted company. So the Mag 7 keeps getting more and more market cap, the more like, say, an employee at an S&P 500 company keeps adding to their retirement account. So it keeps adding to the market cap there. The other issue is then the index funds were meant to be niche. They weren't meant to be enormous. And now some of these index funds, they own equity ownership of over 40% of the shares of some of these large publicly traded companies. I don't think John Bogle intended that.
Right. And then there's all these mimic funds. So if you think of think about like $30 trillion of companies, of funds that mimic the S&P. So they're like passive, but they're like mimickers, or ETFs that basically copy the index. And so it's a lot bigger than you think. And then so when companies go into the S&P, like Lululemon, you see this big nasty, like Lululemon went up 40% into S&P 500 inclusion. Same thing with Uber, SMCI, which is super microcomputer, that went up 100 or so percent into S&P 500 inclusion. And then there was CrowdStrike. CrowdStrike, right before the big debacle here, the big drawdown, that went into the S&P 500. So there's a really sick, disgusting passive game going on where people are gaming the system. These stocks are going up and up. People are buying them in anticipation of S&P 500 inclusion because they know there's 30 plus trillion dollars that has, like when a company comes into the S&P, all these the S&P and all these mimickers have to own these stocks. And so it's quite disgusting. It's quite because with the person paying at home with the 401k, they're just getting screwed.
Well, it sounds like the greater fool theory where people are just betting on higher and higher prices without any fundamental justification whatsoever.
Oh yeah, that's why the S&P is so much more expensive than all stocks around the world. Sure, you can argue that okay, there's some some profits there. But like I said before, the capital intensive nature of the Mag 7 in artificial intelligence, those Capex investments are so large now relative to the way they were. We're talking about going from 30 trillion to 180 trillion dollars annually. And so that Capex is going to hurt profitability over the next, 2 years. And so there's going to be a real rude awakening coming up because nobody really understands the return on capital. Like these billions of dollars are being invested, but nobody really understands, how they're going to get a return on capital.
Yeah, I agree. I would rather own also if the tech companies are going to make those capex investments, if the investments actually occur or they get the government program to do some of the funding. I mean, I would think long term that copper miners, the materials companies, the data center service companies, the electricity, the utility companies, the uranium miners, the power companies, the nuclear power plants are going to be the beneficiaries of that, like a Dominion Energy or Electric more than a big tech company, because they're getting all this capex investment that they weren't planning on even a couple of years ago.
Right. And that's what Buffett hinted at some of this at at his annual meeting. And it's these types of utility companies used to grow at like 1-2% a year. Now they're going to grow, 2 to 3 times that if they're in the right, like you said, if they're in the right part of the country, like Virginia, or if they're in these right regions.
So with the dollar index where it is and the Fed keeping interest rates relatively high, do you think that's causing a lot of problems for foreign banks like that fifth largest Japanese bank that was a market maker for collateralized loan obligations that announced a much larger than expected losses on older US treasuries, and Chinese regional banks, what they just bailed out 40 of them? Do you think that like foreign banks are starting to break first?
That's what typically happens where is the dollar so strong. And in the case of emerging markets, when oil rips with the dollar strength, that really crushes some of these EM banks because everything's priced in dollars. So if oil's up 20% and the dollar's up 10%, then your oil costs a lot more. Thank God we've had a pullback in oil now, but yeah, that dollar strength is causing a lot of stress globally, and that's why there's behind the scenes, there's a lot more pressure on the Fed, not just from Elizabeth Warren and the progressives, but the other central banks really want the Fed to ease. That will allow, like if the Fed eases, that'll allow China to offer more fiscal and monetary response. Whereas if the dollar's strong because the yuan's pegged to the dollar, then it's very difficult for China to offer accommodation.
Well, the People's Bank of China, didn't they have to earlier this week, they had to start cutting rates because that's in response to what they, back in April, they had record amounts of cash withdrawals from their banking system. And then within 6 weeks, they had to bail out 40 regional banks. So it's starting to look like, and yes, it's not causing like total chaos in their financial system, but they're rolling up these little banks into bigger banks. And what do you think eventually that's going to put pressure on their currency? Or do you think that we're going to see cracks or problems somewhere else?
Well, that's it. Is that if they're cutting rates while the Fed is still not cutting and saying higher for longer, that's a big problem. And that's what we saw with the bank in Japan, right? Whereas the Fed is so much more hawkish than the bank in Japan on a relative basis that it creates this incredibly weakness in the currency, and it creates that's going to eventually create more inflation in Japan. But I've got to sharpen my pencil on the Chinese banking system. But yeah, it's something we have to look at in there for sure.
Well, I don't think there's a lot of transparency there. There's Ann Stevenson Yang's newsletter and there's China Beige Book, a few others, but the majority of stuff is intentionally opaque. But I mean, they've been rolling up the little banks into larger banks since 2015, 2019 and 2020. They did a lot of that too.
Right. Yeah, that's Kyle Bass has been brave in that area. Like, it's just like there's too much ever since that 2015, 16 devaluation. It's just a lot of the hedge funds have stayed away from those trades. There's not enough attention on that either.
So I definitely want to ask you about bonds because literally your Twitter handle is ConvertABond.
Yeah.
So do you think that we're in a very long-term bond bear market in U.S. Treasuries? We've had a bear market, a record one for the last 2.5 years. Do you think that it's going to be a lot longer than that, similar to the 1970s?
100%. Like in the previous regime, say from Lehman to 2020, if you had any type of economic slowdown, the reaction function was very swift. You got long the TLT, bond yields on tens would get down to 75 basis points, maybe, in 2020. But just even during, say, Brexit or any kind of economic slowdown, you get this pretty nasty move down in yields, down to say 1.5, below 2%. And now, the new kind of the new level is going to be maybe 3.5 would be the low this cycle next like 5 years. And we're going to be, that's why the curve after the debate with Biden Trump, the curve really started to bear steepen for a couple of days. And all that means is if 2-year yields are here and 30-year yields are here, the steepening traditionally last 20 years, as you move toward recession, the twos always create the steepening. In other words, the twos go down in yield, so the curve is steeper. But what's been weird over the last year and a half, and especially after debate, there's been these times when the curve pretty violently bear steepens, and that's when the 30-year goes up in yield. And so what we call the term premium, the P, all that means in simple language is global investors are not as comfortable owning 30-year bonds in a Trump or a Kamala Harris world. And so they're going to hang out more on the front end of the curve. That's going to eventually force the Fed to come in and support the long end.
Have you ever seen volatility in the 10-year US Treasury yield like we've seen in the last 12 months, or is this a new type of record?
Well, yeah. Ever since October 22 to like last fall, it was pretty crazy. But what people traditionally, the move index will come down once the Fed starts to cut rates and takes more pressure off the. But that's once again, when if we're in this new regime, then we're going to be in a much higher elevated bond volatility world. And so so the move index probably doesn't come down anywhere near the way it has in the past.
Would you describe this bond volatility as more of an emerging market, banana republic, frontier market type of bond volatility that the U.S. is not used to seeing?
Yeah, I mean that's a little harsh, but yeah, where the difference between the U.S. and the rest of the world 5 or 10 years ago was so I mean, it really was American exceptionalism. But now, because of that deficit spending, and all different types of countries in the world need capital. China needs more capital. France needs more capital. And the U.S. used to have the cleanest, dirtiest shirt, and now the U.S. has a pretty dirty shirt relative to everybody else. And so, that's where you get that term, like what you said, is that term premium expansion when the U.S. if the U.S. becomes like just a few 3 or 4% more like Brazil, that's a huge deal. And it's hard to quantify this. And by the way, no academic and no investment professional has really ever truly defined term premium in an exact science. But all it means is if the U.S. becomes 5, 10%, even 5 to 7% more like Brazil, then that creates a little big disruption in the longer end of the curve.
Do you think then a couple of years from now, with fiscal dominance, which is just DC spending is out of control, and the Fed's going to have to, I guess, be the buyer last resort of U.S. Treasuries, because I don't see a lot of the normal buyers of U.S. Treasuries like China, Japan, Germany being large net buyers of Treasuries. Do you think that a lot of the G7 now, so like European Central Bank, Bank of England, Japan, the Federal Reserve Bank, the US, they're going to have to do some type of yield curve control and let inflation run hot, let a real inflation rate rise above, be higher than government bond yields? Do you see that as kind of like the only option over the next couple of years?
This is the only option, because if interest right now is 1.1%, I'm sorry, 1.1 trillion. And so interest as a percentage of tax receipts is getting up in really dangerous territory. And so they're going to have to cut rates to get that down. Now, if they cut rates, that's lowering the front end. They can control that, but that weakens the dollar. That creates a bounce in commodities, and that puts more pressure on the long end. And not only that, if Kamala Harris or Trump's in office, that's just going to naturally put more pressure on the long end. When Trump came into office in 2016, the dollar weakened fairly dramatically from December 2016 to the beginning of 2018. And so you get that dollar. That's why I'm seeing a lot of clients over the last year looking at emerging market local currency bond funds like the EMLC. That pays like 6%, but you own emerging market local currency bonds. You own bonds that are not in dollars, and that type of fund's actually performing really, really well.
And higher commodity prices eventually go into consumer prices and cause profit margins for a lot of the consumer companies. They have to start raising prices or shrinkflation. And so that kind of creates it creates problems for the politicians and people in DC, because then people, when they start to see stagflation and inflation, starts to affect the voters. And that's why inflation is one of the top 2 or 3 issues for the voter right now.
Yes, and so what we talk about in our book, When Markets Speak, is if you look back over the last 2,000 3,000 years, civilizations become very stressed with even 3% inflation. And that's why the Fed has the inflation marker in its mandate. And so, but what they will do is they will deceive the public. They will talk down inflation. Like the Fed, every single press conference, Powell will say, long-term inflation expectations remain well anchored. They say that over and over again because they want the society, the media. It's a big sales pitch on, oh, we have inflation under control. Because if society ever realizes or assumes that the Fed does not have inflation under control, then you can really destabilize very quickly.
I want to ask you about commercial real estate. Do you think that's one of the largest risk areas that is not priced into the banks and the markets yet?
Yes, because what you've seen is Tokyo Marine and some of these global companies that own U.S. commercial real estate. They've marked down a lot of their assets, whereas companies like MetLife and some of these banks in the United States, they've been it's pretty disgusting the way they're marking their books. I mean, if you just look at what happened to New York Community Bank, they admitted that they had risk oversights around marks, and eventually they had to mark everything to reality. What we talk about in the book is there's mark to market, mark to model, and then mark to myth, right? And so there's different sectors that can get different banks, like especially in election year. Regulators in an election year are not going to press the banks on marks, right? They're just not going to, because they don't want to do anything to influence the election, right? Especially if they're most likely would favor Democrats, which is fine. They get sitting governments, incumbent governments always play games with the data. And then once the election comes and goes, then you start to see much more of a realistic mark to market, or the OCC or the regulator comes in and forces the banks to mark things away from mark to myth back to mark to market. And that's what creates a lot of instability, and typically in the first year after a presidential election.
The entities who are actually selling these office buildings or multifamily for all cash deals for pennies on the dollar, it's actually not a lot of the regional banks yet. It's actually like the insurance companies and the pension funds right now. I just see it's almost every day, Monday through Friday, where an insurance company or pension fund's trying to dump one of these buildings all cash at 80% discount or more.
Yeah, and MetLife MetLife is a real potential problem. They increased their exposure right at the top of the market, 2020, 21. They increased their commercial real estate exposure dramatically. I think it's like over around $100 billion of commercial real estate exposure versus 600 billion in assets under management. So yeah, the insurance companies have a pretty big problem.
Yeah, I agree. And they also have losses on older bonds because, like a lot of states, to get their charter to sell insurance in that state, one of the requirements is they have to buy municipal bonds and hold long-term U.S. Treasury. So I think there's losses there too.
Yeah. Oh, yeah. Especially the insurance companies, because they didn't. A lot of them didn't have that Fed facility where the banks were able to move their bonds off at par, which is, which is a big relief. That's what the Fed essentially saved us from financial crisis. One of the things I talk about in our first book, Colossal Failure of Common Sense, is the Lehman crisis. The fiscal and monetary response to Lehman was about $4 trillion. And the fiscal and monetary response to COVID plus the regional bank crisis was 16 trillion. So 4 trillion versus 16 trillion, 4 trillion versus 16. So you just have such an incredible difference in the fiscal and monetary. And part of it is they wanted to get through the election. They wanted to support the economy through the election with this fiscal and monetary juice. And that's where it all unwinds after the election.
It sounds like you think the best case scenario going forward is worse stagflation with the higher commodity prices, the lack of investment on the supply side, especially if big tech is going to make those Capex investments. I mean, we're way undershort on the supply side, a lot of key materials, energy, nuclear power, and that's on top of what regular consumption for emerging markets, China, India, and then regular consumers, if they maintain the normal levels of electricity consumption and food consumption right now.
Yes. In other words, yeah, you want to be long a basket of hard asset companies or commodities and hard assets relative to, it's just like late 21 where you want to be selling tech, you want to be buying. The natural gas companies are so cheap now. The probability that we have a big move up in natural gas this year is really high. Natural gas is a beneficiary of artificial intelligence and energy demand. And seasonally, you're coming into a very good spot for natural gas. We're starting to see a tremendous divergence there. And so companies like Antero, AR, Equity, trading, 3 times EBITDA, they bought back, I think, 10% of their own stock. It's just a cash cow. And if you get a big move up in natural gas prices, those companies become, a lot more profitable. And there's a lot of companies like that. Tourmaline in Canada. You think about deregulation, think about a Trump win with Trudeau. I mean, if you look around the world, look what happened to Macron, right? Look what's happened in the UK with the rise of Nigel Farage, now an MP. And so the people like Macron in Canada are in trouble. And in this kind of election cycle, this type of political movement. And if you have that, you'll have a deregulation cycle where market-friendly people come in to control the Canadian government, and then you're going to see some major explosion in a good way in some of these Canadian natural gas plays like Tourmaline.
There's been a lot of mergers and acquisitions in oil and natural gas too, over 230 billion in the last 18 months. And then in Canada, they just brought online that new oil and natural gas pipeline. So all that oil and natural gas that was selling at huge discounts in Alberta, it can now get moved to British Columbia on the coast and it can sell at a better price.
Yes. And that's what we used to call like Western Canada sour, or, there was a huge spread between this landlocked oil, landlocked gas. And that's all probably going to dramatically change over the next couple of years.
Oh, yeah, I agree. I was an oil analyst for my day job years ago at a newsletter company. So, yeah, I used to cover stuff like that, how the Canadian companies would have huge discounts on their oil and natural gas.
Yeah, but yeah, it's been great. And joining you, I really appreciate everything in terms of like, I think if you read the book, but it's a great book for, the retail investor, because what we're doing, to me, you can get everything in life that you want if you just help enough other people get what they want. And so what we did is we did 140 speeches in 16 countries. We met a lot of incredible investors, and we put, a lot of those secrets and the things we learned around the world in this book, When Markets Speak.
Thank you for writing the book. And how many interviews does David Einhorn actually do publicly? I think he did the interview with you in your book, and he did one podcast interview in the last 6 to 12 months, and that's about it.
Yeah, he's really focused on P&L and and his profit. He's one of the most incredible fund managers. I mean, I think last year, he's been last couple of years he's outperformed the market by 40%. So he's got to do his homework.
And him and Stanley Druckenmiller and Warren Buffett are adding commodities companies, which a traditional value investor would not buy in the past, but that's risk reward where the good value is right now.
Yeah, but Buffett's, taking down Apple, buying more Oxy. and saying, like you said, same thing with Druckenmiller. So yeah, so hopefully we're in good company.
I want to thank you so much for your time today, Larry. Hopefully you want to come back in the near future and talk again about markets. I really enjoyed our discussion today.
Thanks, Jason. All the best.